Ching told us at the top of the show that many businesses, entrepreneurs, individuals are frustrated. The increase in the capital gains inclusion rate was announced, but it hasn't been passed into law. So some people have been remitting taxes on that basis. Some are not. But there is confusion because it's not clear whether that change will ever be officially implemented. Let's get more from Ameer Abdulla, tax partner at EY Private. Ameer, thanks very much for coming on the show. Could you tell me, is there frustration among the clients that you've been talking to, this ambivalent situation over the increase in the inclusion rate?
Absolutely. Thanks, Andrew, for having me. Certainly every time we chat, there's a little bit of drama in Ottawa. This ambivalence in the capital gains inclusion rate, in addition to a number of other tax policies and other policies in general, there is ambivalence there. And certainly there is some frustration in the client community, but also in the tax preparer community as well, because we are, advising our clients to file a certain way or pay taxes a certain way. And, in the current state of our government, there has been a notice of Ways and Means motion proposed that does increase the capital gains inclusion rate, which effectively increases the tax on capital gains, but it hasn't been passed into law. And certainly with the prorogation of Parliament right now, there's still an additional time that we must wait as preparers and the tax community in general until we get some certainty.
Will some people just not remit the tax, do you think, and say, oh, I'll pay the penalties and interest because I'll get it back if it doesn't become law?
Certainly, there are some taxpayers out there who are filing on the basis of the law as it currently stands today. Certainly, Canada Revenue Agency is using their long-standing administrative position where they will assess and expect taxpayers to remit based on the proposed legislation.
Let's get into some other stuff here now.
Sure.
It does get a bit technical. We always love it. You bring great complexity to these things, and we don't talk about them enough. Tax affairs that Canadian private companies can get wrong. Now, some of this involves the so-called small business deduction. It lets you pay lets a small company pay a lower rate of tax on the first $500,000 of active business income. But what's the pitfall here?
Yeah, absolutely. That small business tax rate varies somewhere between 9% and 13% based on the province that the business operates in. And it is available on the first $500,000 of active business income. But the pitfall is there's an interaction between the small business deduction that a company can claim and its passive income that it earns. Since about 2018, there has been an inverse relationship. So the greater the passive income a corporation earns, the less small business deduction it can claim. And so that threshold starts at about $50,000. And at a $150,000 of passive income, the small business deduction actually goes down to zero. So an organization could actually end up paying, instead of the small business tax rate, the full corporate tax rate of about 26, almost double the small business tax rate. And so the pitfall is just making sure that, in the past year, there may have been a lot of passive income generated via higher interest rates on GICs, savings accounts. Perhaps someone has triggered a capital gain and realized passive income that way in their corporation. And so it's very important to make sure that if they're at that $50,000 threshold or higher, knowing how much of that small business deduction they're eligible to take so that they're not surprised when tax time comes around and they may have a bigger tax payable than they would have expected.
It's interesting. When you say passive income, that's simply interest income, for example, on cash?
Yeah, so interest income on cash is one category of passive income. The realization of a capital gain is also passive income. Sometimes certain rents and royalties are also considered passive income. So it's really important for small businesses, large businesses, private companies of all stripes to really connect with their statements and their teams to understand how much passive income they actually have earned in the past year.
There are considerations when it comes to compensation for the owners of small businesses. Tell us, outline that for us, if you would.
Sure, absolutely. So there's many different ways a business owner can be compensated. Two of the most popular are salaries or a dividend. And the pitfall there is it's not obvious at first blush which is actually most efficient. Typically, folks will go the easy route and go down the salary or bonus route and be paid through as an employee. However, dividends on a general basis are actually more tax efficient. This is due to our graduated income tax system and the dividend tax credit that benefits a Canadian person who receives dividends from a Canadian corporation. However, if one thinks holistically, a salary does have other benefits that are not tax, specifically income tax related, such as showing a history of earnings for the purposes of credit and applying for credit, so applying for a mortgage for a home or a loan for a vehicle. In addition, it also adds to a person's RRSP contribution room and also years of service for the purposes of Canada Pension Plan.
Yeah, it gets complicated there. Now, just finally, we're tight for time.
Sure.
What about the excessive interest and financing expenses limitation? I think this was set up to avoid companies hiding profits or at least mischaracterizing profits. Give us what's the possible roadblock or problem here?
Absolutely. So the excessive interest regime has been implemented, so it's not necessarily caught up in this prorogation of Parliament, but it's really earnings stripping arrangements. And it's similar to actually the regimes that exist in many other parts of the world where there are organizations that are larger, so taxable capital of $50 million or greater, or interest in financing expenses over $1 million. So it is a medium-sized to large-sized business issue, but there is a limitation, and you have to compute your EBITDA, so earnings before interest, depreciation, taxes, and the interest expense that one can deduct for Canadian income tax purposes will be capped at about 30% of that EBITDA. And so there is a risk that if you're not managing your earnings appropriately or managing your interest expense appropriately, you may end up with non-deductible interest that can only be carried forward and deducted in a future year.
We'll have to leave it there. I really appreciate it.